Yo my people, welcome back to another episode of Project 30, a 30-day module completely for free where I teach you guys how to trade. Now in today's episode we're going to be going over risk management. Now risk management is very easy. The hardest part about it is actually sticking to it on a long-term basis, if that makes sense. Now mastering your risk management is one of the most important things that you guys can ever do in your whole trading. Learning the technicals, learning the strategies, learning about fair value gaps, liquidity sweeps. This is all easy, this is light work, but that will all crumble if you do not have your risk management unlocked. Now risk management is what will help you stay afloat on them rocky days, on them times in your trading career where you'll be on a losing streak, and no matter how much of a good trader you are, no matter if you're profitable, unprofitable, whatever you are, you will face losing streaks, and it's about managing your risk in them losing streaks to get out of it and stay afloat. Risk management is what will help you preserve your capital. Remember, I always say this to all of my students, capital preservation is a lot more important than capital inflation. So what does that mean? Making money is not important. Preserving your capital in these markets is really important. There's no point in making £1,000, $1,000 in a trade and losing it all the next day. Does that make sense? You want to make sure that whatever you make, you keep the most of it. So without further ado, you guys should know the drill by now. Get your pen and paper and get ready to take notes. Put your title as risk management. If you haven't got your pen and paper ready, get off this video. You're not taking trading seriously. Now, the first thing I want to go over is something called your risk to reward. I want to go over win rate as well. Now, a risk to reward is simply, let's just say if we were to place down a long position and let's just put our TP here. As you guys can see where it says risk to reward, and it says the number 2, this is a 1-to-2 risk reward ratio. So what does that mean? If you were to risk £1,000 on this trade and it was to go and hit your take profit, you would make £2,000. Now let's just place down another long position. If we were to extend our TP slightly more, and as you guys can see, this is a 1-to-3.01, let's just say 1-to-3 risk reward ratio. If price was to come and tap us in, once again, we're risking 1% or $1,000, however much you risk, it doesn't matter. If it hits your TP, because this is a 1-to-3 risk reward ratio, you will make 3 times the amount that you've risked. Now me personally, the lowest I go for is a 1-to-2, and I personally haven't gone for a 1-to-2 in a very long time. But if I was to take a trade, the lowest I would take is a 1-to-2. Why is this? If you were constantly taking 1-to-1s, you would have to have at least a 60% win rate. Now that sounds very easy. All you have to do is win 6 trades out of 10. But deep here, after you have won 6 trades, you only walk away with 1%. Now I should have probably said this at the beginning of the video, but this is not financial advice. Do not take any of this seriously. I can't trade. I just simply look at candles for fun, and I like to draw out things on charts because I'm bored. But back to the video. Now me personally, the lowest I usually risk is 1% to 2% sometimes. Now this is because I go with prop firms, so I'm gonna go more into that in a second. But with prop firms, I risk 1% to 2% maximum per trade. So let's just say I was to have a 100k funded account with like a prop firm, I would risk 1%, which is $1,000. So like I said, you guys want to ideally go for a 1-to-2. Why? You don't even have to win half of your trades to be in profit. You can afford to lose 6 trades in a row. If you win 4, you will walk away with profit, and you would literally be up $2,000 on the account if you would have a 40% win rate across 10 trades. Now my average risk to reward is around the 1-to-3, which is what I really like. Why? Because you don't even have to win 30% of your trades. I can afford to lose 7 trades in a row, and I would still be in profit if I was to win 3 of them. Does that make sense? Now of course, the higher your risk to reward goes, the more you can lose. However, this is the mistake people make, and I do not want you guys to fall into the same trap that I fell into. People think, cool, if the more I extend that TP and the bigger the risk reward is on this trade, then the more money I'll make, the less I have to win. This is the mistake. Inevitably, no matter how much of a good trader you are, no matter what you see on the internet, and there will be a lot of fake traders out there with fake risk rewards. But my point is, no matter what you see on the internet, these high risk reward ratio traders, inevitably, like, it is impossible for them to not have a lower win rate compared to a low risk reward trader. Why is this? Because you're asking for the market to do a whole home run, right? You're asking for the market to do like a big move, and because you're doing that, 9 out of 10 times, sometimes the market can go hit your TP, but a lot of the times you can go near your TP and start reversing on you. Does that make sense? It can start doing all of this stuff in between hitting your TP, and then it might go hit and hit your TP. Now this is the mistake. You got to remember that you're inside of this trade. This is money you're seeing on your screen. Let's just say you were to have a $100,000 account, right? If you were in this trade and you were floating like at the highest level here, a 1-to-7, so you were floating $7,000 on your screen, and then you were to see it come down to literally like what, $500? You were to see it come down to $800. That is a big jump. You will see that one day. You will see $7,000 floating on your screen, and it will go back down to $800. It's going to screw your head. You might end up closing the trade early. You might end up doing something very silly. So this is the problem. For beginners, I say this, high risk rewards is not good for beginners. Why is this? Because you don't have the psychology to be able to see these numbers on your screen and still remain calm and just let the market do its thing. Another thing as well, you have to learn how to manage your trade if you're going for them high risk rewards. You have to know when to maybe close a partial. All of these things, you have to know how to actually trade properly. That comes with time. And that's why I say with beginners, go for medium risk rewards, maybe 1-to-4s, 1-to-3s, 1-to-5s maybe. But don't go into the market and become greedy and try go for a 1-to-10 risk reward. Let's just say, for example, down here, if you guys were to see a liquidity sweep, and then let's just say you took an entry somewhere up here or whatever, it doesn't matter, right? Yes, just because you can go and swing down this TP all the way to whatever it may be, and you're seeing these crazy risk rewards, remember, if you were in this trade, you would have seen this trade go in so much profit back to nearly break even, and now does that make sense? It's going to mess up with your head, and you have to stay more patient with these higher risk reward trades. So just take what the market gives you, like easy TPs equal lows. Take your trade off here. You would much rather, and I'm telling you guys now, you would much rather pay yourself at a 1 to 5 risk reward ratio, which is still in my eyes a high risk reward ratio, but you would much rather pay yourself at a 1 to 5 risk reward ratio, secure $5,000 and let price hit your TP much faster in comparison if you were to swing it down to a 1 to 13, 1 to 15 risk reward ratio, wait 7 extra business days just for the market to go and hit your TP. In them 7 days, you know how much you could have done. So that's what I'm saying. Treat trading like a business. Don't just end up swinging these trades because you feel like it, because yes, there's liquidity here. Liquidity might be somewhere on the other side of the map. It doesn't matter. It does not mean it has to get taken. I told you guys, once liquidity is swept, price can always reverse. So play your cards right. Don't chase these high risk reward ratios. Yes, in the long term, if you do have a high risk reward, you have to win less. However, you got to remember this as well with high risk rewards, because you're losing more inevitably. Let's just say you were to go for 1 to 10s, right? Meaning that if you were to risk $1,000 and this trade hits TP, you're going to walk away with $10,000. Perfectly fine. Let's just say your win rate was 20%. Could you physically imagine losing 8 trades in a row and still trade your strategy perfectly? Does that make sense? Because a lot of people, after they see 3-4 losses, they start fumbling. Forget 8 losses. After some people see 1-2 losses, they start crashing out. They can't handle it. Why? Because they're losing money. Imagine knowing the fact that you've lost $2,000, $3,000, $4,000 on your account, and you still have to remain calm and trade your strategy accordingly. And remember this win rate, we're only accounting for your strategy. So what do I mean by that? Every strategy is different. Every strategy has different win rates, and every trader is different, so they have different win rates. If you've taken 2-3 losses following your strategy, it's very easy for you to go off track and start taking losses that are not part of your strategy. What do I mean by this? Some people might overtrade. Some people might revenge trade. These are all losses that are not accounted into your strategy, so you're going to inevitably end up losing more than you're meant to. You guys might have to rewatch what I just said there again, because I'm pretty sure that just went over your head. Me personally, I'm not a high risk reward trader. Sometimes I've gone for like a high risk reward. The highest I've ever gone for at the time of recording this video is a 1 to 13. Am I proud of it? No. Why do I not care about the 1 to 13? Because it's a 1 to 13. I've done it once, right? It's about these consistent wins that you keep bringing into your account that will pay you over time, not these high risk reward once in a blue moon home run. Because yes, I can hit a 1 to 13, but there's no real, like, there's nothing to be proud of if I can't do it consistently. If the trades that are the 1 to 2s, the 1 to 3s, the 1 to 4s, they're the ones that are consistently paying me, and not these 1 to 13s, like, what do I have to be proud of? Nothing. I would much rather be happy with a medium risk reward, be consistent on that, than chasing out these high risk reward trades. Does that make sense? I'm not trying to deter you guys away from high risk reward ratio trading. All I'm trying to say is, if you do go ahead and do it, I wouldn't suggest it for beginners. And you know what they say in life, more money, more problems. So the more money you're making, the more problems you're due to go through. Now, in general, does win rate matter? Not really. Why? Because you can have the highest win rate in the world. If your risk reward isn't good, then your win rate doesn't mean anything. If, let's just say for argument's sake, I was going for 1 to 0.5s, I could win 80% of my trades. So that means I would walk away with 4% after 8 wins. And then after the 2 losses, I've lost 2%. So it's just dead. I'll be honest, man. Low risk reward ratio trading is just dead. I'd highly suggest you guys personally to go for the lowest 1 to 2, 1 to 3. That will help you stay consistent. It will help your wins cover your losses as well. Does that make sense? Because deep it, with a 1 to 2, 1 to 3, you can afford to lose 2-3 times in a row. 1 win, you've wiped out all your losses. And a 1 to 3 is a lot more easy for the market to hit in comparison to these home runs. Does that make sense? Cool. Moving on. Now, the next thing I want to go over is something called pips. Now, I've said this before in a video, but pips is basically just how much the market moves. How to know how many pips the market has moved? All you do is you hold shift, you click, you let go of shift, you drag like your mouse around on your desk, and let's just say we were to stop here. As you guys can see, the number here on the top right, it says 100.3. This is a 100.3 pip move. Now, ideally, an average session on Euro USD or GBP USD will move around 30 to 40 pips. Sometimes you'll get slightly more, sometimes you'll get slightly less. That all depends maybe if there's a news folder. Does that make sense? But this is important. Why? Because if you're trading like me on the lower time frames during these sessions and my TP was to be 100 pips, right? This is super unrealistic. Why? Because I know that unless there's a high impact news folder to drive towards my TP, most likely this is not getting hit in that same day. I mean, personally, I don't carry trades over into the next day. It's just too much headache. There's so many different problems that you can encounter as well, such as bad spreads during Asia, slippage, etc. All of these things. So that breaks my rules. And second of all, it's just super unrealistic to have a TP that big unless you're swing trading. That's the only time you can have a big TP, if you're swinging these trades on a higher time frame and you're entering on higher time frames. But if I was to take a trade during the London session and if my TP was to be 20, 30 pips, this is perfectly fine. 40 pips, whatever, that's perfectly fine. These are realistic expectations you can have in the market with how much the session should sort of do. Does that make sense? Now, why pips are important is because it helps you calculate your risk, right? Entering a trade isn't just as easy as telling your phone enter for you and risk this much automatically. You have to actually enter a trade yourself. So for example, let's just say for argument's sake, we had this fair value gap here marked out. Let's just say we would take an entry off of the fair value gap and we would put our stop loss on the most recent swing low. As you guys can see, if I put my stop loss there, this number here in the middle, 25.3, this is how big my stop loss is. Now, during every single trade, you should know how big your stop loss is. Why? Because it helps you calculate your risk. Before I go on to how to actually calculate your risk, I need to go over to teach you guys how to place down a trade. Now, I'm pretty sure I did tell you guys in episode 1, 2, to or free not to get a live account, not to get a funded account just yet. Watch this like boot camp that I prepared for you guys, and then if you want to get an account, that's up to you. I'm not holding you accountable. But as for now, I'm going to teach you guys how to actually place down a trade. Now my personal advice for you guys would be to demo trade for at least 3-4 months of profitability before you jump onto a live account. This is going to help you know that your technical analysis is actually on point and you're consistent on paper. Paper trading is very good. Why? Because it helps you practice the skill and you're not making any money, so you're not focused on making money and you're actually focused on mastering the skill. Does that make sense? So the first thing I need you guys to do is go over on your iPhone and download MetaTrader 5. Search up MetaTrader 5 and download that. Once you guys have downloaded it, you want to press on it. Once you press on it, you press allow, accept, right? Open a demo account, fill in these details here, obviously put in whatever. I'm just going to put in a random name. Also make sure that when you do put in your number, if you're in the UK, put +44 your number. Don't just put in 07 whatever. Where it says account type, press Forex hedged USD. Leverage, put it to 1 to 500. That's just to make sure you don't have any issues when it comes to placing down your trades. Press accept and press register. Press start and you should now be loaded onto a page like this. Now I'm going to help you guys set up your MetaTrader 5. Now the first thing you guys want to do is press this pencil on the top right and delete every single thing here unless it's a pair that you personally trade. Me personally, I'm not seeing anything on here that I trade, so I'm going to delete all of them. Once I've deleted all of them, I'm going to search up Euro USD. I'm going to add that. I'm going to press that green button on the left. Then I'm going to search up GBP USD. I'm going to add that. These are the two pairs that I trade. So I'm going to keep them on my watch list to trade whenever I want to. Now to navigate your way around MetaTrader, you guys can go to charts. This will just simply show you the actual charts of Euro USD. Of course, don't really look at this. Look on your trading view. Analyze on your trading view. Place your trades down on your MetaTrader. Turn your MetaTrader off. Don't look at the numbers. The only time you should go on your MetaTrader is if you're going to set a TP, set a trade, set a stop loss, close a trade, close a partial. That's it. Anything to do with actually figuring out where price is going to go, stay on your trading view. Now the next thing you guys want to do is press the middle button trade. Right now, if you guys, let's just say for argument's sake, you guys wanted to enter a trade, all you guys have to do is press this add button and make sure at the top it says Euro USD or GBP USD. Whichever one you guys want to trade, just press Euro USD, press GBP USD. Let's just say we want to trade GU, and that we can enter a trade. Now you see where it says instant execution. If I buy right now, if we go over to Euro USD, my entry will literally be where price is right now because I'm instantly executing on the market. Does that make sense? Now there's something called buy limits. Now buy limits is basically just, if we were to go over here, let's just say I wanted price to automatically enter me into a trade whenever we tap into, let's just say, this order block down here, this little small order block. If I wanted price to automatically tap me into a trade, all I have to do is put my entry on the order block on TradingView, put my stop loss wherever I want it to be, and you see the number that it says here on the right of the screen, 1.0975. That's where I put on the price, right? So the price is your entry, right? So you literally put 1.0975 is what it says, I'm pretty sure. So 1.0975. So the price is your entry. The stop loss, of course, I want to copy the stop loss over here, and you guys can see the stop loss is 1.02830. I can't even see 1.02830. Take profit, let's just put in like a random number over here, 1.3, and I don't know why it's not letting me place down the trade. That is a bit weird. It's because I wrote the entry number down incorrectly. There we go. Now I can automatically place down the trade. Now as you guys see on Euro USD, if I go over to the 15-minute time frame, all I have to do is press the charts, press M15. You guys can see my entry is on that exact order block that we have here marked out on the screen. Now the good thing about MetaTrader 5 is you can literally press your TP, go over to charts, right? Press your TP and you can drag it, like let's say you want to put it on this high. You can see how much money you're going to make from this trade. As you guys can see, $13. All I have to do to modify my TP for it to go there is press this blue button here on the bottom right, the little arrow there. Press that, press modify, and there you go. Like that will modify my TP for me. Same with my stop loss. All I have to do is press the stop loss, drag it up, press that blue arrow, modify, it's automatically done it for me. Now let's just say the trade has now hit my TP and the trade is now invalidated, whatever it may be. All I have to do to close the trade is go over to trade, swipe right, press this red button and press delete. That will delete the limit for me. That way when price does come down here, it's not going to enter me into a trade. Another way you guys can place limits is literally, you see on the top right of the screen, there's a blue and red box. Press the red box. This will bring out this little tab for you guys, and what you guys can now do is press the circle. When you press the circle, you guys can drag your buy limits, right? You can put it on this order block, wherever you guys want it to be, this order block here. And if you guys wanted the sell limit, just put it above price and literally it will let you put a sell, let's just say off of this order block here. Whatever it is, you guys can literally play around with it. Press SL, put your stop loss on the swing high, whatever it is. TP, place it wherever you guys want. Press the blue arrow and press place limit. That way you guys can place the limit and you don't have to put in all of these numbers like I've just done it there. And that's probably the bad way to do it. The best way to place your limits is the way I've just showed you guys here. Literally just place your limit on the chart. Now cool, once again, we want to close the trade. So we just go over here, we press swipe right, we press delete. Now you guys can see here, at the top it says 0.01. This is how many lots you guys are buying, all short selling if you're in the sell. Now lots is basically, just think of it like how much you're buying, right? If the more you're buying, the more risk is on the line. But literally the more lots you have, the more risk is on the line, right? So let's just say we went in 10 lots into the market and let's just do an instant execution for a buy. This is a demo account, so no, this isn't affecting my life. I'm down $40, I don't care. But as you guys can see, if we go over to charts, where that arrow is, this shows us where our buy is. So let's just say for argument's sake, I wanted to buy exactly like right now. I can literally place my stop loss here, right? Instead of me going over here and trying to put in all of the numbers over here and just get hella confused, all I have to do is go over to chart, press the buy, press SL, put it down on this swing low if I wanted to, press the blue arrow, modify, boom, my stop loss is now placed. And as you guys can see, I'm risking $680 in this trade. For my TP, all I have to do is literally press TP, put it on the high if I wanted to, and now I can literally press the blue arrow to modify the trade, and boom, my trade is now set. If let's just say I wanted to close a partial, so let's just say it's gone up in profit and I'm now happy to close a partial, all I have to do is swipe right here. You see where it says 10 lots. If I want to close 50% of my position, all I have to do is change the number from 10 to 5. Press close. That will automatically close half of your lots and you will still be in 5 lots worth of buys, if that makes sense. Now let's just say I wanted to close the entire trade. All I have to do is here, press close, boom. And as you guys can see, I have now closed this trade and I've made $60 on my demo account. Yay. So I'm hoping that all makes sense for you guys. Now I'm going to teach you guys how to actually calculate your lots. Now before I do that, I want to show you guys something. On the screen I'll put up right now where you can find your spreads, right? I've taught you guys about spreads in the other video. I can't remember which video it is, but I've taught you guys about spreads. If you haven't watched that video, make sure you go and check it out. I'll leave the link somewhere here. But now spreads are important. Why? Because we have to account for spreads when we're inside of a trade. Otherwise, we can get taken out too early of our trade. So when you guys go on your MetaTrader and you go on quotes, on the top left where it says EURUSD, there'll be a number in brackets that look like this. I'll literally put a screenshot there and you guys will see somewhere over there with an arrow where you can see the spreads. Now ideally the number you guys want to see is ideally 5 or lower, right? The lower the spreads the better, like I've taught you guys. Now why spreads are important is because let's just say if we were to go back over to the charts, if I wanted to buy off of this fair value gap, if let's just say the spread is 5, this just means that the spread is 0.5 pips. So instead of me buying directly off of this fair value gap, what I then have to do for a buy is rise my entry 0.5 pips. So let's say I was to have my stop loss on this swing low. You guys can see this entry is 10.7 pips. So I'd have to add on 0.5 pips to my entry. That will be 11.2 pips. This is now the entry I want to be placing if the spread is 5, right? So you have a slightly bigger stop loss, which ruins your risk reward because obviously the tighter your stop loss, the bigger the risk reward is. Now the difference is with a sell, what you guys have to do is, let's just say we want to take an entry off of this fair value gap, keep your entry the same. The thing that you want to make bigger is your stop loss, right? So let's just say our stop loss was on this swing high. You guys can see this is 13.5 pips. So let's just say the spread was 0.5 pips, right? All I would do is I would have to add 0.5 pips onto my stop loss. So for a sell, increase your stop loss. For a buy, raise your entry. You guys might have to rewatch that a second time, but essentially I'm gonna repeat it again. For a buy, raise your entry, keep your stop loss on the swing low. The stop loss doesn't have to get bigger. For a sell, keep your entry the same, put your stop loss higher. If you guys want to know why that literally is, I explained more about spreads in the other video. Once again, I'm gonna leave a link somewhere on the screen for you guys. You guys make sure you go and watch that. Now the actual most important part, how to actually calculate your lots. Now because we're on a 100k demo account, that is USD, make sure it's USD. But essentially because it's a 100k account, the best way I can put it for you guys is, let's just say we were to take an entry off of this fair value gap and put our stop loss on this swing low down here. You guys can see this is a 10.6 pip stop loss, and let's say we were to account for spreads, so that would be 11.1, assuming that your spread is 5. If it's 4, then make it 0.4 pips bigger. If it's 3, make it 0.3 pips bigger. However, you want to account for the worst case scenario. So if your spreads are usually changing between 3, 4 and 5, account for 0.5 pips. But all you guys want to do is go over to your calculator on your phone, and because it is a 100k account, what you guys want to do is put in 100. Right, only 100, not 100,000, just 100. You guys see this is 11.1 pip stop loss. So what I want to do is press divide, and I want to divide that by 11.1. Once I divide that, this will give me how many lots I want to be buying. You guys can see it is 9.009. So literally at this point, I want to go back over to my MetaTrader 5. I want to press that buy button and I want to place in 9.00. It's not going to let me put in the 9, so I'm just going to have to go in 9 lots. Now let's just say the stop loss was to be on this swing low here. This is now a 9 pip stop loss. What do I now have to do? I have to do 100 divided by 9. This is now 11.11 lots. So 11.11 lots. You guys can see whenever it taps back into this entry, and I want to place my limit here and put my stop loss on the swing low with 11.11 lots. That's the way I learned it, and I'm teaching you guys it because once you get your head around it, it's very easy. Learning how to use MetaTrader will take you 3-4 days. It's very confusing at first, but once you know how to use it, it's just like using your phone and scrolling on TikTok. But yeah, as for now, that is the most easiest way you guys can calculate your lots. Now before I teach you guys how to calculate your lot sizes for a GBP account, I just want to quickly say, make sure you guys go ahead and join the Discord link in the description. It's a free server where anyone can join. We've got so many different sections in here: executions, outlooks, crypto traders, self-improvement channels, car channels, gym channel. There's so many ways that you guys can benefit from this server alone. It's completely for free, so I'd highly suggest you guys do it. No other trader, no other server is doing it like us. And inshallah, by the time you guys would have joined this server, we would have added so many different channels and so many different sections to help you people out there for free. Speaking about free, there's a free value section in here as well. Now if you guys want exclusive access to my strategy, daily markups, resources, live trading sessions and so much more, make sure you go check out the link in the description. But without further ado, let's continue on with this this video. So what you guys will now want to do is go back to your app store and download something called FX Calculators. I'll leave a screenshot on what the app actually looks like on the screen somewhere here. Now once you're on the app, it should take you over to something here. Get rid of that. Press position size. Now as you guys see, once you're on here, make sure that your account currency is on the currency that your account is. So whether that be a euro account, a GBP account, you guys want to go over here. Now for your account balance, let's just say it was a £100,000 account with a prop firm that deals in pounds. If you guys want to risk in percent, make sure that it says over here where it says amount at risk, make sure that it's on percentage. Unless you want to make it so you're risking in pounds, like however many pounds you want to specifically risk. For risk, let's just keep it at 1%. And let's just say for a stop loss, which is 5 pips, you guys want to press that. And you see where it says standard lot, anything below it. So if I just highlight that, it's not letting me highlight it, but you guys can see below standard lot, it says 25.017. So in this case, I would want to go back over to my MetaTrader, and let's just say it was a £100,000 account. I want to go over to trade, and I want to place in, how many lots did that say? 25.01. Right, and that's how many lots I want to place in my trade. Now this was a pretty long video, but I'm hoping it all makes sense for you guys. I'm hoping the explanation wasn't too rushed or anything. I do speak a bit fast, so apologies for that. But if that didn't make sense for you guys, just rewatch the video, put it on 0.1 times speed, and hopefully it makes sense for you guys. Also, I just quickly want to say, if you guys are looking to get a prop firm account, make sure you check out Breakthrough Capital. I'm currently a 6-figure funded trader with Breakthrough Capital, and they're doing me pretty well so far. So I'd highly suggest you guys check these lot out. Also, one more thing, if you guys are trying to take your trading seriously onto the next level, like I said, make sure you go check out the link in the description. It's been your boy OneFX. Take care, my people.